Welcome to the Deep Dive. Today, we're plunging into the fascinating world of financial trading strategies.
Hmm.
Think of these strategies as, well, more than just ways to potentially make money. They're really about having a well thought out plan for navigating the financial markets.
Right.
It's about aiming for higher profits, yes, but equally important is keeping a firm grip on risk. These aren't based on hunches. They're systematic approaches rooted in facts, market trends, and even sophisticated predictive models.
That's right. It's really about establishing a clear framework for making decisions, kind of moving beyond those impulsive actions that can often lead to trouble in the market.
Definitely.
For you listening, this deep dive is your chance, really, to understand the core logic behind these strategies, why they're so crucial, and how they're constantly, evolving in response to the market. Consider this your direct route to a solid understanding.
And our expert guide for this exploration is Understanding Financial Trading Strategies, Essential Financial Trading Strategies for Navigating Market Trends and Challenges by Kalyani Rajay. It's a resource that was recently updated December 2024.
Good source.
Yeah. Our goal today is basically to extract the most important insights, what makes these strategies work, how market conditions impact them, where they might fall short, the growing influence of algorithmic trading, and the often overlooked value of analyzing past market data.
And just to get us started with something, well, truly interesting. Did you know that in the UK, the 18 to 34 age group now accounts for a remarkable 65% of all online traders?
Wow, 65%.
Yeah. This trend has been steadily climbing since about 2015. What's intriguing here is what this huge shift might tell us about the changing nature and perhaps the accessibility of financial markets now.
That's a great hook. Okay, let's unpack the fundamental reason why financial trading strategies are so important. I mean, it's easy to assume it's all about hitting it big, right? Making money. But our source material highlights a much broader purpose.
Absolutely. While generating profit is obviously a key objective, the text places significant emphasis on managing risk effectively. It's huge.
Okay.
These strategies often incorporate tools like diversification, spreading your investments across different types of assets.
Right, don't put all your eggs in one basket.
Exactly that. Spread them out to reduce the impact if one investment doesn't perform well. They also use hedging, which is kind of like taking out an insurance policy against potential losses, and derivatives, those financial contracts, whose value is linked to something else, an underlying asset, and they can be used for hedging or speculation.
Okay, so it's not just about maximizing gains, it's also about building a kind of resilient financial approach. The resource also touches upon capitalizing on various market opportunities. Could you explain that a bit further?
Yeah, what's interesting is how different strategies are tailored really to take advantage of specific market dynamics. The text points to day trading, for instance.
Right, quick in and out.
Yeah, traders aiming to profit from price changes within a single trading day, holding positions for maybe minutes to hours. Then there's swing trading, which focuses more on capturing short to medium term price swings, so typically holding positions for days, maybe weeks.
Okay.
And finally, long-term investing, which is about sustained growth over extended periods, months, years, even decades. Each of these uses, distinct strategic approaches based on the time frame and what they expect prices to do.
And perhaps one of the most crucial aspects, and I can say this from personal experience with my own limited ventures into the market, is that these strategies instill discipline. The temptation to act on impulse can be really strong.
That raises a really important point, the whole psychological side of trading.
Mm-hmm.
The source correctly emphasizes that having a defined strategy act as a crucial safeguard against those emotional decisions, the ones driven by fear or greed.
Mm-hmm.
By sticking to a preset of rules and objective criteria, traders can aim for more consistent, more sustainable outcomes, minimizing the influence of those cognitive biases we're all, prone to.
So, okay, how do these structured plans actually lead to greater profitability? I mean, having a strategy is one thing, but how does that translate into, well, making more money in practice?
Well, the core really lies in the systematic analysis. By rigorously examining market trends and relevant data, traders can more effectively identify and hopefully take advantage of potentially profitable opportunities. The
Hmm.
text gives some good examples of this.
Such as momentum trading and trend following. What's the basic idea behind those?
Precisely. Momentum trading and trend following strategies are built on the idea that assets whose prices have been moving strongly in a particular direction, well, they're likely to continue on that path for some time.
Okay.
So the strategy involves identifying these sustained price movements and essentially, riding that wave to try and generate profits.
And then there's the concept of mean reversion. which sounds a little, well, the opposite to what we just discussed.
It does, interestingly. Mean reversion strategies operate on the opposite principle. They're based on the idea that asset prices tend to gravitate back towards their long-term average or mean value after temporary deviations.
Ah, okay.
So if a stock's price has dropped significantly below its historical average, a mean reversion strategy would suggest it's likely to bounce back, presenting a potential buying opportunity. Conversely, if it has spiked way above its average, it might be seen as a signal to sell.
It's like expecting things to eventually balance out. And you mentioned how these strategies help us steer clear of those emotional trading decisions. Could you remind us how that works in practice?
Yeah, if we connect this back to behavioral finance, you see that a well-defined strategy provides objective rules. Rules for when to enter and exit trades.
Right.
You're not making decisions based on fleeting feelings, oh, this feels like a good time to buy, but rather on predetermined signals generated by your analysis. That discipline is absolutely key to avoiding impulsive actions that can lead to, significant losses.
Right. And it's not just about the timing of buying and selling, is it? It's also about protecting any profits you might make and limiting potential losses.
Exactly. The source emphasizes the importance of integrating risk management tools directly into these strategies. This includes things like setting stop-loss orders.
Okay, yeah.
Imagine you buy a stock at $50, you set a stop-loss at $45. If the price drops to $45, bang, it's automatically sold, limiting your loss to $5 per share. Another crucial element is diversifying your portfolio across different assets to lessen the impact if one particular investment performs poorly. These components are vital for safeguarding your capital and contributing to overall profitability.
Now, the market isn't static, is it? It's constantly shifting, evolving. How do these ever-changing market conditions affect the effectiveness of these carefully planned trading strategies?
This raises a really important question about adaptability,
Yeah.
Economic data releases, geopolitical events, shifts in how investors are feeling sentiment. All these things contribute to a dynamic market environment. A strategy that performs brilliantly in one set of conditions might really struggle in another.
Can you give us some concrete examples how different strategies might fare in different market climates?
Certainly. Like we discussed, momentum trading and trend following tend to be most effective in relatively stable or, clearly trending markets where price movements are sustained. Predictable, almost.
Right.
However, during periods of high volatility, with rapid and unpredictable price swings, these strategies can become much less reliable. They can potentially lead to what are known as whipsaws, getting in on a trend only to see it reverse super quickly, resulting in losses.
Ouch. That makes sense. You're trying to ride a wave that keeps collapsing unexpectedly.
Yeah.
What about those mean reversion strategies when the market is highly volatile?
Interestingly, high volatility can actually create more opportunities for mean reversion strategies.
Oh, really?
Yeah, the temporary mispricings caused by sharp market movements can offer chances to buy assets that have been oversold, with the expectation that they will eventually return to their average value. However, and this is crucial even with mean reversion, increased volatility also raises the risk that those mispricings might become the new normal. So careful risk management is even more critical then.
So it sounds like you can't just, create a trading strategy and expect it to work flawlessly forever. You need to be prepared to adapt and adjust.
Absolutely. The source stresses the importance of adjusting your risk management in response to volatile periods, perhaps by reducing the size of your trades, your position sizes, or implementing tighter stop-loss orders.
Makes sense.
It also points out that during economic downturns, more defensive strategies like diversifying into less risky assets or using hedging techniques become more important. Conversely, during periods of economic expansion, maybe focusing on high-growth sectors might be a more aggressive but potentially rewarding approach.
It's a continuous process then. Evaluation, adaptation, it seems. Now, even with the most sophisticated strategies and constant adjustments, there must be limitations, right? What are some of the inherent drawbacks of relying on these models?
That's a really important point to consider. Despite all the research and planning that goes into developing trading strategies, market uncertainty is it's an unavoidable limitation.
Yeah.
Predicting price movements with absolute certainty is simply not possible. Unexpected events can always occur, things that can disrupt even the most well-designed strategies.
So even the experts can't see everything coming. What else should we be mindful of?
Well, the source highlights the potential pitfall of over-relying on historical data. Many strategies are developed by analyzing past market trends, past behaviors.
Sure.
But it's crucial to remember, the future isn't always a direct replay of the past. market conditions can shift dramatically due to various factors, rendering previously successful strategies less effective or even useless. Think about the impact of new technologies or, unforeseen global events. These can fundamentally alter market dynamics.
That makes perfect sense. Past performance isn't a guarantee of future results, like they always say.
Exactly.
You also mentioned the influence of emotions earlier. Does that still pose a challenge, even when you have a defined strategy in place?
Unfortunately, yes. Even with a well-structured plan, the temptation to deviate from it because of fear or greed can be very strong indeed.
Mm.
For instance, a trader might panic and sell their assets during a market downturn, even if their strategy says hold on. Or they might get overly confident after a few successful trades and take on excessive risk, ignoring the parameters of their strategy. This emotional interference can really undermine the effectiveness of the plan.
And what about the practical side, just executing trades in the market?
Market liquidity can be a significant factor. If you're trying to buy or sell a large volume of an asset and there aren't enough buyers or sellers at your desired price, well, you might experience what's called slippage,
Slippage, okay.
essentially getting a less favorable price than you anticipated. This can erode your profits or make your losses worse. The source also points out that some more complex strategies require a significant level of expertise and resources for their development, implementation, and ongoing monitoring that might not be accessible to every single trader.
So it's not a foolproof system. You need to be aware of these potential challenges and, again, be prepared to adapt your approach. Now let's talk about technology changing the landscape. Algorithmic trading seems increasingly important. How do these algorithmic strategies offer a competitive edge?
What's particularly interesting here is how technology enhances the core principles of strategic trading. Algorithmic trading involves using computer programs to automatically execute trades based on predefined instructions and conditions.
Right.
This allows for trade execution that is significantly faster, more precise, and, frankly, more efficient than manual methods.
Speed and precision, that sounds like a huge advantage, especially in fast-moving markets.
Absolutely. Algorithms can process and analyze vast amounts of real-time market data to identify optimal trading opportunities and then execute trades in fractions of a second. This capability for high-frequency trading enables firms to react almost instantly to market changes, potentially outperforming those relying on manual trading.
And you mentioned earlier how strategies help remove emotional decision-making. I'd imagine algorithms take that to a whole different level.
Exactly. By executing trades purely based on data-driven criteria, algorithms completely eliminate the influence of human emotions and the potential for human error. This ensures a consistent application of the trading strategy, preventing those impulsive decisions we talked about that can often lead to negative outcomes.
And it's not just about executing trades faster, is it? There's also the ability to refine and rigorously test these algorithms beforehand.
That's a crucial benefit, yes. Algorithmic trading allows for extensive optimization and backtesting. By running the algorithms on historical market data, traders can simulate how the strategy would have performed in the past, identify any potential weaknesses or areas for improvement, and fine-tune the parameters before deploying the algorithm with actual capital.
That sounds like a very powerful tool for continuous improvement and risk management. Okay, let's shift focus a bit and discuss the role of information. Our source material talks about the correlation between financial trading strategies and secondary market research. What exactly is secondary market research in this context, and how does it help develop effective trading strategies?
Secondary market research, in essence, involves analyzing existing information. So reviewing financial reports, studying industry trends, examining academic research, all to gain a deeper understanding of market behavior and historical performance.
Okay.
It's about building a solid foundation of knowledge before you even start to formulate a specific trading strategy.
So it's like doing thorough background research before starting a new project. How does this historical and contextual data actually inform the trading decisions you make right now in the present?
Well, think of it as providing a wider lens through which to view the current market landscape. Secondary research can help identify long-term trends, maybe recurring cyclical patterns, correlations between different asset classes, or key market indicators.
Right.
This historical perspective can then inform your current trading decisions, helping you to anticipate potential market shifts and adjust your strategies accordingly. For example, research might reveal a historical tendency for, say, a particular sector to outperform during specific phases of the economic cycle.
It's about recognizing those patterns and using those insights to make more informed predictions about future market movements.
So,
The source also mentions the role of benchmarks and performance measures. How does secondary research help there?
this is where you begin to evaluate the potential of your trading strategy even before you put it into practice. Secondary research provides benchmarks derived from industry standards and the historical performance of similar strategies.
Yeah.
By examining how comparable approaches have performed in the past under various market conditions, you can get a sense of whether your proposed strategy is likely to be viable and, what kind of returns you might realistically expect.
So it's a way to kind of validate your ideas and make sure they're grounded in some historical reality. And it can also help you identify areas where your strategy might need some tweaking, right?
Precisely. By comparing your methods and anticipated outcomes against established benchmarks and the performance of others in the market, you can pinpoint potential weaknesses in your strategy. You can gain valuable insights into areas where you might need to adjust your approach.
Yeah.
As the source emphasizes, combining this understanding of historical data with real-time market analysis leads to more evidence-based and adaptive strategies. It reduces reliance on just gut feeling or speculation and increases the probability of success through well-informed decision-making.
Okay, let's try and consolidate what we've learned. We've covered a significant amount of ground here. What are the sort of key takeaways from our deep dive into financial trading strategies?
Well, in essence, financial trading strategies provide a systematic framework for navigating the complexities of the financial markets. The primary objectives are increasing profitability and effectively managing risk.
Right.
Their success isn't static. It depends heavily on understanding and adapting to the ever-changing dynamics of the market. And while these strategies offer a valuable roadmap, it's crucial, absolutely crucial, to recognize their inherent limitations like the unpredictable nature of the market and the potential for our own emotions to interfere.
Mm-hmm.
Finally, leveraging the power of technology through, say, algorithmic trading and grounding your strategies in robust secondary market research. These are essential elements for maximizing their potential for success.
So the real aha moment here maybe is understanding that vital interplay between having a well-defined plan, being flexible enough to adapt to market shifts, and making data-driven decisions informed by both current analysis and historical context. It's a dynamic, ongoing process, not just a one-time setup.
Exactly. And this leads us to a final thought for you, our listener. Given the increasing accessibility of sophisticated trading tools, and, like we mentioned at the start, the growing number of younger individuals actively participating in the financial markets, how might the widespread adoption of these strategic approaches ultimately shape the very nature and evolution of financial markets themselves?
Interesting question.
What new challenges, what new opportunities might emerge as more and more participants embrace these systematic and data-driven trading methods? It's definitely something worth contemplating as you continue your journey in the financial landscape.